Now let's come to question number 51. 51 question is very similar to the question that we have already discussed. But the good part to learn from question number 51 is the way it has framed. They have asked almost the same thing but in a different manner. So let's read the question first. Suppose you are a treasurer of XYZ PLC in UK. Okay? XYZ has two overseas subsidiary. One is based in Amsterdam and another one is in Switzerland. Both of them are in different places. Switzerland itself is a country, Amsterdam is a city. So in a Netherlands. Okay. The surplus position of the fund in hand is as follows, which it does not need for the next 3 months but will be needed at the end of the 91 days. Holding company which is in UK, right? Swiss subsidiary which is in Switzerland. Dutch subsidiary which is in Netherlands, that is Amsterdam. Okay, so this is Amsterdam, Switzerland and UK. So the surplus with all the three companies is like this. Exchange rate as on the date are as follows. Spot rate for euro. Now you tell me, where do you think the euro will be applicable? In holding company UK. UK's currency is pound, sir. And Swiss franc is applicable for Swiss subsidiary, CHF. And euro will be applicable for Amsterdam. Okay. Spot rate for pound per euro is given to you. Euro is the base currency. So this is the base currency, euro. And 91 days points are given. PTS means points. These are in ascending order. You can clearly see 37, 40. So we are going to add them. Spot rate for CHF per pound is given. So pound, that is our currency, our home currency is the base currency in this case. And 91 days points are going down. You can clearly see 242 and then 228. So we are going to deduct it. Let's first do one thing. We can just calculate the forward rate. We have to add these points in this case. So let me just complete the calculation. 0.6858 plus 0.0037. So this will be 0.6895, 0.6869 plus 0.0040. That's 0.6909. Okay. And in this case, we are going to deduct because the swap points are going down. 2.3295 minus 0.0242, that's 2.3053. 2.3326 minus 0.0228, that's 2.3098. Cool? Okay. 91-day interest rate on per annum basis on the deposit in money market are as follows. This is something different that you will have to learn, that you will have to decide in which particular range or criteria your investment is falling. If you invest 1,50,000 pound, so 1,50,000 will come under this and the rate will be this 1,50,000 pound. Second, 19,96,154 Swiss franc. 19 lakh will come under this Swiss franc, the rate will be this. Am I right? And 14,50,000 euro. 14,50,000 euro again will come under this, and this is going to be the rate. So these are the interest rate and this is how you have to pick the interest rate. You might get confused here with the income tax slab. This is not to be treated according to the income tax slab. Some students might say that on the first 2 lakh of the investment we will get 1%, and then on the rest we will get, like up to 10 lakh we will get 2%, and up to 20 lakh we will get 4%, and above 20 lakhs we will get 5.38%. No sir, this is not income tax slabs. This is where, like, how much you are investing. Whatever your amount is, only one range will be applicable, and the entire interest rate will be applicable on the total value. Okay. Now, you have been approached by your banker wherein the above mentioned surplus was lying. See, we have the surplus fund for the next 91 days. We can invest those surplus fund in their own country. There are two options. Do you remember pulling method? We can pull all the other like Swiss subsidiary and Dutch subsidiary surplus into UK, convert them in pound, and then invest the net amount. But we can invest everyone's surplus amount in their own country also. Now, what is the question? Above mentioned surplus was lying, requesting you to swap the surplus. This is currency swap. But see how beautifully it is presented. Swap the surplus lying with the other two subsidiaries and place them in deposit with them. Determine the minimum interest rate per annum up to 3 decimal point that should be offered by the bank to your organization so that your organization is ready to undertake such a swap arrangement. What does that mean? Did you understand? No, sir. I'm not getting exactly what the question is saying. The question is simply saying one thing, that if we ask the other subsidiaries to send the entire money that they are having, the two subsidiaries, the surplus, to UK, okay, then what will happen? Both of them will get converted into UK pound, and we will add 150 in that, and then the total will be invested in UK. The question is, how much interest rate should be given on that total amount so that sending money for the Swiss subsidiary and Dutch subsidiary also, sending money is justifiable. This has to be compared with another option where these subsidiaries can invest in their own country, and after 91 days it can be converted into pound. So first we will have to solve the question and ask everyone to invest in their own country for 91 days. And at the end, you can convert the Swiss franc and the euros at forward rates that we have just calculated in pound. Okay. This was the question that we have already done, but the framing is different. So what will happen, I will tell you. See. XYZ PLC shall be ready to undertake this swap arrangement only if it receives the interest on the surplus fund if invested on individual basis as follows. So, if they invest in their own country, this should be Netherlands, Switzerland, UK. They are investing euro, CHF and pound in their own country. So you can see what are the rates available. If I go for Netherlands, like they are calculating like this, na. So Netherlands is Swiss franc. Netherlands is going to be 14,50,000. So 2%, 0.5% and 1%. These are the interest rates that has been chosen. 2%, 0.5% and 1% for 91 days, 91 days, 91 days. So these are the interest that they will receive along with the principal of 1450, 1996, 154 and 1,50,000. So the amount after 91 days will be principal plus interest, and this is at the end of 91 days. Now you have to convert them in the pound and see what is the total. So if everyone is allowed to invest in their own country, and then at the end of 91 days all the cash flows if converted into pound is giving you 20,20,511 pound. Okay, this is one alternative that is available all the time to both the subsidiaries. But the question is asking the Switzerland and the Netherlands subsidiary that send all the money that you have today itself to UK instead of investing in your own country. So the question is like this: swap to sterling, swapping this CHF and euro to sterling. That's the only question. So what are we going to do? today if we sell this Swiss franc and euro, what will be the exchange rate and what will be the pound? I am not putting myself into picking the exchange rate. Now you are very good at the base currency and finding out bid or ask rate, right? So you will sell all the Swiss franc that you have today and euros in pound. You will convert that, or we can say swap that in pound. So the total pound from both the subsidiaries will be this. We already had 1,50,000. So the total that we will have today is 20 lakhs 173 pound. Now the question is how much interest we should receive on this for 91 days, minimum return. Obviously, the minimum return that we should receive on this investment should be so much that at least at the end of 91 days, the total along with the interest is equal to this much. Because if this amount along with the interest is lower than this 20,20,511, then we will never swap all the cash flows, that is euros and CHF, into sterling. You just analyze this thing. If swapping into sterling will give you less of the cash flows than this, then why will you swap the cash flows into sterling? You will not do that, right? So at least the minimum to minimum, swapping should give you the return so that the GBP at the end of 91 days in this option should be at least equal to 20,2511. So you have this much of the amount at time 0, this much should be the value at the end of 91 days. The difference between these two is the return that you should earn. This is the minimum return that you should earn under swapping option. Swapping, in other word, is nothing but immediately pulling. You remember that question where the answer was pull all the cash flows immediately? This is nothing but swapping. Swap the CHF and euro into sterling immediately. And this option should give you minimum return of 2338, which comes to, see, 2338 on the amount that we are ready to invest today. This includes all the three amounts, and that is for 91 days. This return is for 91 days, converted back to 360 days. I think the days was not given in this question. We can take 365 as well. Yeah, it was clearly given in the question that we have to take 360 days. So question is very much clear about this calculation. Converted into per annum, and the answer is 4.023 per annum. Now, let me go through the previous question where this 4.023% was already given in the question itself. See, you remember this immediately pulling or investing independently. In the last part of this 484,080, we invested the entire rupees at 6.2% rate. Do you remember that 6.2% rate? That's the interest rate which this question is asking you to calculate. That's the interest rate which the question is asking you to calculate. And it's very simple, sir. This option should give you this minimum rate of return, which makes the total cash flows equals to this much. Minimum 475, 323. In this case, though it is already higher, but at least this much should be the cash flows. If we are getting more than that, well and good. But if we are getting less than that, then we will not pull the cash flows. So in order to be, just a second. In order to decide that we have to swap all the foreign currency cash flows into sterling, the minimum return that we should get on all the investment is 4.023%, because this percentage will make this option equals to this one, indifferent of both. Anything above 4.023 will make sure that we are going for the swapping option, but anything below 4.023 will reject the swapping option. So thus the minimum rate that should be offered is 4.023%. Do you get that? I'm not going into the exchange rate part in this case. Let's have a look on question number 52 now. This is an interesting question asked in the January 21 exam. Interest rate for 3 months is given to you. in USA and Canada. See, there are 4 different rates are given. There is one correction that you should, instead of this, you should write deposit. So borrowing rate for dollar and Canadian dollar, US dollar and Canadian dollar, and deposit rate for US dollar and Canadian dollar. Both are given. 4 rates. And Canadian dollar by US dollar spot rate. It is not in ISO code in this question. They have simply writing it as Canadian dollar, this is the price currency, and this is base currency. So base currency in this is US dollar. See, only when they will write CAD instead of CAN and dollar. If the symbol is there, don't consider that as ISO code. Okay, so this is a normal rate. Canadian dollar is the price currency, base currency is US dollar. So whatever you want to buy and sell, interpret that or put your requirement to the bank in terms of US dollar. Okay. Today's rate, spot rate, 3 months forward rate. Advise the currency in which borrowing and lending for 3 months needs to be done. We can solve this question using interest rate parity theory if you are strong at that, because this requires a lot of knowledge. But without that, if you don't want headache and you want to just solve it, you can do it very easily also by trial and error method. Take 3 months is equal to 90 by 360. What we are going to do, what is the difficult part in this question is, till this point we have not been given with 4 interest rates. We were like 2 interest rates are given, 1 spot and 1 forward rate was given. Here we can see that the exchange rates are also 4, the interest rates are also 4, and at that time it is difficult to pick one rate. But I will give you a hint. Whenever such type of questions are asked, normally if you will borrow in dollar, just understand, if you will borrow in US dollar, it is obvious that you are going to invest in Canadian dollar. That is for sure, right? And understand, let's pick one. If you borrow in dollar and sell that dollar today itself, if you sell that dollar, bank will buy it, so bid rate is applicable. And if this is the rate applicable, in the forward this rate will be applicable. Because in order to make the repayment at the end, you will have to buy US dollar, bank will sell US dollar at the end of 3 months at this rate. So cross figures in cross will be useful. And if you go the other way, you can do it like this, these rates. So all the blue rates will be applicable in that when you invest in dollar, US dollar and borrow in Canadian dollar. And the black figures, the black circled figures will be applicable when you borrow in US dollar. Okay, how to solve this question, sir? Let's keep it easy and solve it according to the institute first. Question number 52. This is the timeline. Let's say you borrow US dollar 1000. Because the values are not given, we can assume anything. If you borrow US dollar 1000, what is the US dollar borrowing rate? US dollar borrowing rate is 4%. All these rates are per annum. We have to borrow only for 3 months. So 4 into 3 by 12 will give you 1%. What I will do is I will just write down the percentages. 1%, 2.5 by 4 will give you 0.625%. 4.5 by 4 will give you 1.125%. 3.5 by 4 will give you 0.875%. So these are the rates applicable for 3 months. So 1% will be the rate, right? And what will happen at the end of the 3 month? You will have to repay 1010 US dollar. The repayment will be 1010 US dollar. But instead of borrowing US dollar, if you borrow equivalent Canadian dollar. Now, what do you mean by equivalent Canadian dollar? In order to compare it with this one, we need to make sure that we are buying the Canadian dollar in such an amount that if we sell that Canadian dollar, we will get the we will buy the US dollar, and that amount will be equal to 1000. So, what is the Canadian dollar amount to buy US dollar? So, we want to buy US dollar, let's say for example, by paying Canadian dollar. Okay, how much US dollar we want to buy? 1000. We want to buy dollar, bank will sell it. The bank's dollar selling rate is 1.240. So 1000 multiplied by 1.240. This much of the Canadian dollar is required to borrow $1,000. So this is also $1,000. This is also $1,000. That means 1240 Canadian dollar is the equivalent amount of 1000 US dollar. How to calculate that? It's very simple, sir. The amount which you will pay, and after paying this amount, if you will buy US dollar, it should be 1000. So after paying 1240 Canadian dollar, we will get 1000 US dollar. That means this is correct figure. Okay, sir. 1240. If you will borrow Canadian dollar, the interest rate will be 4.5%. You can clearly see the Canadian dollar interest rate is 4.5%, and for 3 months it is going to be 1.125%. So we are going to add 1.125% interest. In this we added 1% for 3 months. Let's do the calculation. So what will happen at the end? We will have to pay the Canadian dollar of 1253.95. Now understand, we have to pay the Canadian dollar. That means we will have to first buy Canadian dollar by selling US dollar. We have to pay it as a borrowing. We borrowed this Canadian dollar, right? We have to make the payment to the party, and for that purpose we need to buy this much of the Canadian dollar. Na? First we will buy it and then make the payment. And for that purpose you will sell. You will have to buy this much in order to make the payment, and for that purpose you will have to sell USD. If you will sell USD at the end of 90 days, bank will buy it. What is the rate? Bank's dollar buying rate is 1.255. Am I right? 1.255. So at 1.255, 1253.95 is a Canadian dollar. 1.255 is also a Canadian dollar. So it will be divided. So 999.16. Now understand, if you directly borrow the dollar, the outflow is $1010. And if you borrow Canadian dollar first, then the outflow in US dollar is 999 only. So which option is better? Where the outflow is least or lesser. So this option is better, borrowing Canadian dollar. That's it. The answer is with you. If you are borrowing Canadian dollar, you will invest in USD. You will invest in USD. Conclusion. Borrow Canadian dollar. Invest in USD. This is one way of calculating. I will just show you the other way. Instead of borrowing, if you start with investment, let's see. Invest USD 1000. What is the investment rate? The deposit rate for USD is 2.5%, and for 3 months it is going to be 0.625%. So how much we are going to receive? 1006.25 at the end. This is what we will receive if we invest $1,000 today. But instead of investing in USD, if you invest in Canadian dollar, if you invest the Canadian dollar, what will happen? You will have to invest this much of the Canadian dollar. In order to invest this, we will have to first buy the Canadian dollar. And how many Canadian dollars should be purchased? So that you will have to pay 1000 USD, equivalent to this. So by selling US dollar 1000, you will receive some Canadian dollar, invest that. It should be equivalent, right? So 1000, sell dollar today, bank will buy it. If you will sell the dollars today, US dollar, bank will buy it. That means 1.235. So 1.235, 1000 multiplied by 1.235. This many US dollar, Canadian dollar will be received by you and you will invest that. How much interest you will earn on this Canadian dollar? The deposit rate for Canadian dollar is 3.5%, which comes to 0.875 for 3 months plus 0.875%. So you will receive Canadian dollar 1245.80. What are you going to do with that? What are you going to do with that? It's very simple, sir. You will sell those Canadian dollar and you will buy US dollar. How many US dollar you will receive? You are buying at the end of 90 days US dollar. Bank will sell it. The selling rate is 1.260. At the end of 90 days, bank's ask rate is important, 1.260. So 1245.80 divided by 1.260. You will only receive 988.74. Now you decide whether you want to receive $1,006 or you want to receive only $988. Obviously, we will go with $1,006. That means investment in dollar is preferable. So what is the conclusion in this case? Invest in USD. That means opposite will be for the other currency. Borrow in Canadian dollar. So from both the options, we are coming to the same conclusion. So one of the two will be enough for the exam. Institute has given the answer like this. See, first they are borrowing dollar, borrowing Canadian dollar. So if you borrow US dollar, the outflow is 1010. But if you borrow Canadian dollar, the outflow in US dollar is 999. That means this option is preferable. That means borrowing in Canadian dollar is preferable. If you are borrowing in Canadian dollar, invest in US dollar. If you go with lending, means investing or deposit, still you can see that investing in dollar is giving you more money than investing in Canadian dollar. 988 only. I just showed you 988. Here 988.74. So investment in US dollar is better. Again the same decision. Invest in US dollar. That means borrow in Canadian dollar. That's it. From both the options, you are coming to the same conclusion that the question is asking. Question is asking you in which currency we should borrow Canadian dollar and lend US dollar. Simple, sir. If you want to do it our way also, the other way, which is interest rate differential and the premium and discount, you can do that. But for that purpose, you have to take all those rates. The two interest rate will be applicable. The black circle rate will be applicable in one case and the blue circle rates will be applicable in one case. So you separate the data, four values here, four values here, and apply that premium and discount wala concept there. From both the calculation, you will come to the same conclusion that invest in US dollar, borrow in Canadian dollar. If you want me to show one of the two calculations, let's just do it. So I will take interest rate differential. I will take all the black circled figures, right? So you can see the interest rate difference between 4 and 3.5% is 0.5. 4 minus 3.5 is 0.5% per annum. That means the forward premium in low interest rate currency, or we can say forward discount in high interest rate currency. This is US dollar, this is Canadian dollar. So the base currency is US dollar in the exchange rate. Let's talk from this angle. And this rate is higher. That means US dollar should be at a discount and that discount should be of 0.5%. Until the discount goes to 0.5%, we will invest at a high interest rate currency because the interest rate is high. But if the discount goes beyond this rate, if the discount goes beyond 0.5%, we will borrow. Now let's find out the premium or discount in US dollar, which is the base currency. Okay, and that too per annum. So 12 by n into 100. All the black circle figures 1.235, 1.260. So forward rate is 1.26, spot rate is 1.235 divided by 1.235 into 12 divided by 3 months into 100. You can see it is at premium. Which is at premium? Dollar is at premium. Whereas the dollar is high interest rate currency. It should be at a discount of 0.5%, but forget about the discount, it is at a premium. Now if you will draw the timeline, this is 0, this side we take premium, this side we normally take discount. So according to the interest rate differential, 0.5% should be the discount in dollar. So somewhere around this 0.5%. 0.5% should be the discount in dollar, but in reality it is 8.07%, 0.97% premium. The dollar should be here, but it is at this place. Now understand, the dollar should be at discount. That means unless and until it is at discount, we will invest in this phase and we will borrow in this phase at a high interest rate currency. So if it is at premium, investment in the dollar is the answer. Invest at US dollar. You can clearly see that. What do we use to say for the high interest rate currency? That it should be at a discount until it reaches the interest rate differential, that is 0.5%. But forget about the discounting, it is at a premium, man. And this entire side explains that until the discount in dollar reaches to this point, we are going to invest in the high interest rate currency, which is dollar. And once the discount goes beyond the interest rate differential, we are going to borrow at that currency. Forget about the discount, it is at a premium. So the answer which is there is invest in US dollar. Simple. That means borrow in Canadian dollar. Same answer is coming for this example as well. Okay, forget about this now. Let's move on to the next question. Question number 53. Interesting one. Have a look. The treasury desk of a global bank incorporated in UK wants to invest GBP 200 million. And this is incorporated in UK, so this is our currency. On 1st January 2019 for a period of 6 months and has the following options. There are two options where you can invest your money. The equity trading desk and the fixed income desk. You can clearly see that one option is to invest in the equity, the other option is to invest in the fixed income. That means some kind of bond. Okay. And the equity trading desk is available in Japan, wants to invest the entire 200 million GBP in high dividend yielding Japanese security, equity, that would earn a dividend income of this much, Japanese yen 1182. If we invest in the securities today, we will earn that much of the income, Japanese yen 1182. Okay, let's start along with this. Question number 54. So if today we have to invest in Japanese yen, the very first thing that we will have to do is we will have to convert the GBP in Japanese yen. So 200 million GBP has to be sold in the market. Let's find out what is the base currency. You can clearly see from this that 148 should be Japanese yen per GBP and 1.28 should be USD per GBP. So GBP is the base currency. We will put the requirements all the time in GBP. We want to sell GBP today at spot. Sell GBP, bank will buy it. Acha, the good part in this question is there are no two-way quotes. All the quotes are one way. There is no bid or ask separately given to you. So this rate is applicable today for converting the pound to Japanese yen spot rates. 148.002. So 200 into 148.002, 148.002 will give you 29600.4. This is what you are going to invest in the Japanese yen. And after investing this much, Japanese yen 29,600.4, you will receive the dividend. How much dividend? Dividend of Japanese yen 1182 at the end of the 6 months. Now, let's read further. The dividends are declared and paid on 29th June. You can clearly see this is the 1st of January 2019 and 29th June is just one day before the end of the 6 months. So we will consider it as end of the maturity. Post dividend, after the dividend is paid, the securities are expected to quote at a 2% discount. So whatever we invested in the Japanese yen, which is 29,600.4%, it will reduce by 2%. It will fall by 2%, minus 2%. 29,600.4 less 2% will be Japanese yen 29,008.39. Okay, so this will be the value of our securities and this will be the dividend income. Okay. The desk also plans to earn Japanese yen 10 million on a stock borrow and lending activity because of this investment. So what are we going to do for the 6 months is that since we have borrowed some Japanese security, for this 6 months we are going to lend our securities to someone who is in need, who is doing the short who is taking the short position, and we are going to earn some income from that as well. And that stock borrowing and lending scheme will give us additional income of Japanese yen 10 million. Okay. On a stock borrow lending activity because of this investment. The securities are to be sold on 29th June with T+1 settlement. So if we sell the securities on 29th June, it will be settled on 30th of June, which is exactly 6 months. And the amount remitted back to the treasury in London. Now what will happen? Just do the total of this Japanese yen that we have. We have 3 types of Japanese yen currencies. The income of 10 million for stock borrowing and lending, income of 1182, and the value, principal value. So 29,008.39 plus 1182 plus 10. So we will be having 3,200.39. All those will be sold back and converted into GBP. So what is the rate after 6 months? Japanese yen to GBP rate after 6 months is 150. You can clearly see Japanese yen to GBP 150. So convert it at 150. How many GBP you will receive? 201.34. And you can clearly see the investment initial was 200 and you are getting 1201.34. So 3356, or we can say 1.34 is your gain. 1.34 millions in GBP is your gain. True. So this is the first case when you invest in equity. But what if you invest in the fixed income desk in the United States, other country, where you are going to get 5% per annum? It's very simple. This is the very simple part. See, you sell the GBP here, 200, and buy USD. Let's see the rate. What is the rate of converting GBP into USD? At spot is 1.28. So 200 multiplied by 1.28 will give you 256 million US dollar, on which you are going to receive 5% per annum for 6 months. So we will add 2.5% in that. And we will get USD 262.4, which will be sold back to the UK. And what is the conversion rate after 6 months? 1.30331 after 6 months. 1.30331. and you can see we have 201.33. So you invested 200 and you are getting back 201.33. The gain is 1.33. So practically speaking, you are having the same gain in both the options, almost same gain. 1.33 and 1.33. Now tell me, in which security you will invest? In which option you will invest? Japanese equity or US bonds? It's very simple, sir. Since the gain is equal, gain is similar, the profit is similar in both the options, I will go with the US bond because bonds are safer option than equities. Equity, investing in the equity means taking risk. And if after taking so much of the risk, I'm getting a return which is equivalent to the risk-free bonds, then I will surely go with the bonds. Why would I take the risk and have the same return when I can get the same return without taking any risk? Let's have a look. Investment in Japanese yen is preferred over the investment in USD as there is a marginal gain. But from a risk perspective, the company should go for option 2, investment in government securities, as they are risk free. Or there can be another answer. The equivalent amount at the end of 6 months shall be almost same in both the option. The bank can go for any of the option. But from the risk perspective, the investment in fixed income desk of US is more beneficial as the chance of variation in the fixed income security is lesser as compared to the equity desk of Japan. All in all, it wants to say the same thing, that if the returns are same, go for the risk-free security instead of equity. Got it? Question number 54. I think this is the same question. Index fund of Japan and treasury bills of US. Exactly same. You are going to receive the dividend. The format is different. Dividend, income from stock lending, and the discount on initial investment. So once you convert the 400 billion rupees, and it will be like this. Interest on that, and these are the exchange rate. You keep it for homework. Exactly similar to question number 53. And you can see that the answers are also matching once again in both. So you can invest in any one, but since the returns are same, go for the treasury bills because that is risk free, or at least we can say lesser risk is there. Question number 55 in front of you. We'll take it after this break. So this is quite interesting. Question. Have a look. Mr. A Limited is planning to import equipment from Japan, which will cost 3,400 lakhs yen. The company may avail loans at 18% per annum interest with quarterly rest, with which it can import the said equipment. Now see, we can take the loan at 18% and pay 3,400 lakhs to the party in Japan. But the interest has to be paid with quarterly rest. So compounding is quarterly. The company has also an offer from Osaka branch. Osaka is in Japan. So we have an offer from Osaka branch, the bank in Osaka, of an Indian bank extending the credit of 180 days at 2% per annum against an opening of irrevocable letter of credit. Additional information is this, that the today's exchange rate is this and the 180 days forward rate is this. In this case, this is your base currency rupees 100. Commission charges for opening the letter of credit is 2% for 12 months. We need it only for 180 days. So only 1% will be applicable. Advise whether the company should accept the offer. So there are two options to finance this machine. You have to find out the total cost in both the options. In whichever option the cost is lowest, you will go with that. Okay. Just understand, if you borrow money from India, first option, borrow money from India taking a loan of 18%. What will happen? You will have to buy 3,400 lakhs yen, and for that purpose I think you have to give 1,000 rupees, 1,000 lakh rupees. So 3,400 divided by 340 into 100. 1000 lakhs. So 1000 lakh rupees has to be given to the exchange dealer, and then he will give you 3400 lakhs yen, and you can give it to the party in Japan and he will send you the machine. But in order to sell 1000 lakh yen, 1000 lakh rupees, we will have to borrow this much. So the borrowing in rupees is 1000 rupees, 1000 lakhs. How much you are going to borrow today? 1000 rupees in lakhs, 1000 lakhs rupees. Okay. And you are going to pay interest on that at 18% per annum. So 18 divided by 4 means 4.5% per annum with quarterly rest. So understand. Question number 55. This is the timeline. Okay. You will borrow 1000 lakhs in rupees. You will sell that. You will buy 3400 Japanese yen, and you will pay 3400 to the party, and he will send the machine. That is how it is going to go. So this particular thing will carry interest of 1.045 for the first quarter and 1.045 for the second quarter. Just multiply. All the payment has to be made at the end of the 180 days. 1000 into 1.045 into 1.045. That will go to 1092.03. This is the cash outflow in first option when you will borrow money from India. Okay, cool. This is the easiest one. But if we borrow, see, if we take the help of the Osaka branch in Japan, just imagine that branch will make the entire payment to the party in Japan itself. The party will send us the machine. The party will send the machine to us. But in order to open the LC, letter of credit, with that branch, we will have to make him make the payment of opening charges, which is 2% per annum. And we have to open it for 180 days. That means 1% per annum. So how much is the opening charges? LC opening charges? 3400 lakhs yen into 1%. That means 34 lakh yen. So we will have to pay him 34 lakh yen today itself. How are we going to pay this much? We have to first buy 34 lakh yen in the spot market. In order to buy the 34 lakh yen, we will have to sell 10 lakh rupees. By selling this much of the rupees, you will get 34 lakhs yen that you can pay to the Osaka branch. They will open the LC in your own name, and then they will make the payment to the party. They will make the payment to the party. They are basically giving you a credit of 6 months to make the payment of this. Okay. And how come this 10 lakh rupees is going to be in your pocket? You will have to borrow 10 lakh rupees in Indian market at 18% per annum, on which you will be paying quarterly interest for 2 quarters. So this 10 lakh into 1.045 into 1.045, that means 10.92 lakhs. So this is just the charges of opening LC. This is what you will have to repay at the end of 180 days, because you borrowed 10 lakh rupees today in order to buy 34 lakh yen so that you can open LC. Now after 6 months, what will happen? After 6 months, you will have to make the payment to the Osaka branch, right? How much? 3400 lakhs? No sir, 3400 lakhs plus interest for 6 months. You can clearly see this was the opening charges, but this commission charges for LC is 2% for 12 months, 1% for 6 months. So the payment that you have to make, this is rupees first, keep this in mind. So you have to pay Japanese yen, how much? 3400 into 1.01, that is 3434 lakhs yen at the end of 180 days. How are you going to pay this much of the amount to the Osaka branch? You will have to buy it first by selling INR. What is the rate at the end of 180 days? Sir, the rate is 345. So 3434 divided by 345 into 100. 995.36. So you will have to make a payment of 995.36 lakh rupees. That's it. This is also outflow. So do the total of these two figures. 994.36 plus 10.92. You can clearly see that the total outflow under this option is 1005.28. That's it. So which option is preferable? Sir, this option is preferable, opening the LC with Osaka branch, because the net outflow in this case is less. In this case it was 1092. In this case it is only 1005. Have a look on the answer. This is when you finance it from India, the machine. 1,000 lakhs. You borrowed 1,000 lakhs, interest for the first quarter, and then on both of them the interest for the second quarter, 1092.03. Okay. You can calculate it this way. This is the easiest way, 1.0545 to the power 2, because you are applying it 2 times. And let's come to the Osaka branch. The offer from the Osaka branch should be accepted or not. In order to open the LC, we will have to make a payment of 334 lakh yen, which will be purchased by paying 10 lakh rupees. Okay, 10 lakh rupees. And this answer is wrong by the institute. If we will borrow 10 lakh rupees, we are going to pay 1.045 to the power 2, the answer of which will be 10.92. So what they are doing is they are not compounding here. They are not doing the compounding here. So 10.92 lakhs will be the outflow. 10.92 lakhs. That is the time zero. That is the cost of opening the letter of credit. But at the end of 180 days, you will have to make the payment of 3,400 lakhs yen and interest at 2%. See, the question has not mentioned whether you have to take 360 days or 365 days. So they have taken 360 days, 365 days, and that's why the answer is varying little. Otherwise, it would have been 3434, 1%. And in order to make the payment, you will have to buy the yen at the forward rate. And the total outflow will be this. This option is cheaper than the first option. Option 2 is cheaper. That's it. Easiest one. Okay, let's come to question number 56. This is a little technical, little ambiguous question by the institute. So we are going to focus on each point and we'll try to understand. But at the end, there might be some ambiguity which will be left with this question. We are going to move on from that point. Messrs Sky Products Limited, Mumbai, an exporter of seafoods, has submitted a 60 days bill for 5 lakh euros drawn under an irrevocable letter of credit for negotiation. Now what might have happened? I will tell you. We have to create a story, right? We need to understand the question. Question number 56. Let's say, for example, this is an exporter and this is an importer in the other country. Exporter, importer in the other country, and this is the bank in our country. Okay, and this is the bank for their country. Now, these parties are important. What happens is that importer wants to purchase some goods from this exporter and exporter also wants to sell some goods to the importer. But exporter is worried about the payment. If he ships the goods to the importer, what is the guarantee that importer will make the payment? Right? So he's worried about that. He don't want to take any kind of a stress of going to that countries and fighting in the court with the importer for the payment, because this guy, this person or this company is a non-resident in this country. And what is the solution to that? Exporter can ask for advance payment to the importer before shipping the goods. But if you think from the importer point of view, if he makes the advance payment, what is the guarantee that exporter will send the goods to him? Or even if he sends the goods to the importer, what is the guarantee that the quality of the goods will be exactly same as what discussed between these two guys? So both of them are facing the trust issues. And in order to complete the transaction, what is going to happen? These two banks will play the role. Now, what will happen? The importer will go to this bank in order to issue letter of credit. So this bank, after doing all the careful analysis of this importer and credit worthiness of this guy, bank will issue letter of credit on behalf of importer. These documents will be transferred to this bank. This bank will be called as confirming bank. This bank will be called as issuing bank. So the confirming bank will confirm to the exporter that we have received the letter of credit. What does that mean? It means that this bank is giving guarantee on behalf of this importer. This bank is giving guarantee on behalf of this importer. It means that you can send the goods to the importer, and even after that importer refuses to pay for the goods, then the bank will make the payment. So exporter is not worried now about the payment, and importer is also like he is receiving the goods beforehand. Okay, so this is how the letter of credit works. Understood? Now, what happened? This letter of credit had an original date of payment of 60 days. So basically speaking, either the importer or the bank, this bank, will pay the amount after 60 days only. Okay. Now understand what happened. This is a timeline of 60 days. Okay. We sold the goods of 5 lakh euros on this date, and we are supposed to receive 5 lakh euros after 60 days. True. What if everything happens in a normal route and we receive 5 lakh euros after 60 days? In India, we are going to sell those euros to the bank and receive rupees. So if we sell the euros, bank will buy the euros. The bid rate of rupees per euro is applicable. But the problem in this question is direct rate of rupee per euro is not given. We will have to use the cross rates. Okay. For that purpose, let's frame the equation first. We will take this here, and the cross rates can be calculated like this. If one part is bid, all the other parts will also be bid. Rupees per dollar into bid of dollar per euro. Now please confirm that the codes are given exactly what is exactly in the format, in this format, rupees per dollar and dollar per euro. You can see that we have rupees per dollar and dollar per euro. So the codes are given exactly in the same manner which is required in the cross rate equation. Okay, sir. But the problem is that we need the rates of 2 months, not today, because we will receive 5 lakh euros after 2 months and after 60 days, and then we will convert on that day's rate. So the forward rate of 2 months are required. So all these rates, bid of rupees per dollar or bid of dollar per euro, should be of the 2 months forward. Now let's come to the table. Be careful in analyzing this, because lot of students, I will say 99% of the students might have made this mistake in exam. This is the spot rate given to you. 1 month forward, 2 month forward and 3 month forwards are given. 1 month forward and 3 month forwards are not at all required. Just ignore that values. We need 2 months forward. Okay. Now you can clearly see the swap points are given in ascending order. That means we will add this. This is also in ascending order. We will add this. But can you see the difference? 21 is the paise. 22 is the paise. And paise is applied just after this decimal on this part, 80 and 81, not from the last. A lot of students will just use this 21 as the points. It's not the points, it is 21 paise that we have to increase. So 67 rupees 80 paisa. In that, if you have been asked to increase 21 paisa, will you put this 21 on the last 2 digits or the first 2 digits? It's the first 2 digits after decimal. So 67.80 plus 0.21. Understand, it will be like this. Let me write it here. 67.8000, 67.81, 00. So you will have to write it like this: 0.2100 and 0.2200, not on the last digits. If these would have been simple points and not paise, then we would have kept it on the last two digits. So this is one place where most of the students might have made the mistake. So this is 68.01, 68.0300. One thing. Another point is with the USD euro. So this is rupee per dollar. Now let's do the same for dollar per euro. I will just take it here, dollar per euro. Now understand, in the dollar per euro, the cents are given. In the similar manner, the cents are for the dollar. 100 cents is equal to $1. But there is a slight variation in the presentation of paise and cents. Paise are given as 21 and 22, cents are given as 0.4 and 0.45. What does that mean? This 0 is the cent. So if they would have given 21.25 cent, that means these two should be the cents that would have applied on the first two digits. But 21 is not given, it is 0. See, I will show you. 0.20 means 0.20, and all these are cents. 20, it is not, we cannot call it as 20 cents. It is 0 cent, 0.20 cents. So these two will be for the first two digits and these two will be third and the fourth. What I want to say is the cents will be applied from the last, on the last two digits. Here. Sir, how come? It's very simple, sir. These are given after decimal. So practically speaking, the first two spots will be taken by the figures or the numbers on the left hand side of the decimal. And the last two digits will be taken by the numbers on the right hand side of the decimal. So these 20, 40, 70 are for the last two digits. And if there is something on the left hand side, these are for the first two digits because these are cents. So whatever you write, it cannot be interpreted as dollar, it will be interpreted as cents. So 20, let's say for example, this is 20. 20.70 cents means 2070 after the decimal in this. 2070. Because after the decimal, the cents will start. This is the difference between this. See, the 0 point is not in the paise, but point is there in the cents. So we are going to apply these figures on the last two numbers, and we are going to apply these figures on the first two numbers. That's what the difference is. Very difficult to understand, and I think 99% of the students would have made this mistake. But that's okay. Institute is unnecessarily trying to put some trying to trick the students unnecessarily. This is way too much that they have gone. I think they should have simply written as 20 cents, 40 cents, 70 cents. If there would have been no decimal points here, then I would have replaced this 20 with 0 and 7. Replaced means added 20 in 0 and 7. But because of this decimal, I would assume that whatever is on the left hand side will take the first two places, and whatever on the right hand side will take the last two places. Okay. Let me just write down now. 1.0775, 1.8 000. Now 40 and 45 cents. I will write it like this: 0.0040 and 0.0045. Do you get that? This will be 1.0815 and this will be 1.8045. Way too much to understand. And that's okay. If you have made a mistake, that's totally okay. Even I made the mistake while reading this question for the first time. And that's totally okay. These are the 2 months rate. And understand that we need the bid of rupees per dollar and dollar per euro. And both the rates are given as required. So take the bid. That means, just a second. Yeah, that means this rate, bid of this and bid of this, 68.01 into 1.0815. Now there will be some ambiguity left in the question because of this. I will tell you why this is going to happen. There is an exchange margin of 0.1%. Okay. And it has been clearly written that both rupees per dollar and USD per euro are interbank market rates. That means exchange margin is not adjusted in these two. But what the institute has done, let me just show you. These figures are matching 68.01, 1.0815. But what institute has done is they have deducted the margin only from the rupees per dollar rate, not from the USD or USD per euro rate. You can see there is no margin. Why? This is also interbank rate. This is also interbank rate. Why we are not adjusting the margin in USD per euro? Some people might start the discussion that we are in India and that's why on Indian currency only it will be applicable. That is baseless. In the coming question you are going to see that we are applying the margin in such type of rates as well, if these rates are interbank rates. Interbank rate means this cannot be applied to the merchant. These can be applied to the merchant only after adjustment of margin. First thing. Second thing, you should be very clear. So this much of the ambiguity will be there. I am not sure now what should I do. According to me, we should calculate the cross rate and at the end we should add or less the margin. Since this is a bid rate, we are going to deduct the margin. If you remember the forward margin, this is bid and this is ask. This is a cash outflow to the bank and this is a cash inflow to the bank. And margin is always a cash inflow to the bank, right? So this is cash outflow, cash inflow. We are going to deduct this, and both of these are cash inflows. We are going to add margin. So deduct margin from the bid rate, add margin in the ask rate. This is a bid rate. We are going to deduct the margin, and they have deducted the margin properly. But the main problem is why the same was not deducted from USD euro rate. So that's where the ambiguity will be left. Okay. So I'm not continuing this cross rate now. You can continue it, but it will not match then with the answer given in the institute. Okay. I will just take this rate 67.9420, which was adjusted with the margin, and 1.0815. This is the cross rate, right? Which was not the 1.0815 is not adjusted with the margin. Now I will assume this as the rate. I will continue with the rate given by the institute in the answer, 73.4793. I am not calculating the one from my side because it will not match with the institute. So suppose the correct answer is that, and we take this rate. So 73.4793. Am I right? 73.4793 is the rate at which I would have received 5 lakh euros. True? But what is happening is that today itself I am going to the bank and I am asking that whatever I would have received on that date at 73.4793, please pay half of that to me today itself. And rest of the half, because the bank will discount the bill, exporter is going to the bank to discount the bill or to release the bill of 5 lakh euros. And he said that please give me 50% of that and rest of the 50% in EEFC account. 2,50,000 in EEFC account. EEFC account is the export, see, exchange. I will just show you. Exchange earners foreign currency account. What is this account? This account is for those people who do not want to convert the foreign currency into rupees. The normal RBI rule says that the moment you receive foreign currency, you will have to sell it and get the rupees. You cannot hold the foreign currency. That is the normal rule. But the problem is that, let's say for example, I have received dollars and immediately I have to make the payment to some party in America. I should be allowed to use those dollars directly to be transferred to that person. But under the rule by the RBI, first I will sell that dollar, get the rupees, and sell that rupees, get the dollars, and then pay it to the party. This is wrong, because by doing this couple of transactions, I am incurring transaction cost, I am incurring the exchange margin charges as well. In order to avoid this, you can transfer your earnings in foreign currency in this account. And you can use this account directly for making the payment. This way, you will not be asked to convert that foreign currency into rupees. You can save on the transaction cost, you can save on the margin as well. So that's what I asked the bank to transfer this, and rest of the 50% should be given to me. Okay. Now understand that you would have received this much of the rupees per euro on that date, and you are asking the same 6 or 2 months back. What will happen? Obviously, they will give it to you. The bank will give 2,50,000 into 73.4793, which was payable to you on this date, and they are giving to you 60 days before it. So the amount that will be given to you is 183,69,825. Okay. Two things that you have to notice till now is, this is the exchange rate applicable or quoted by the bank, but I am asking the money 60 days before. So this is going to be the cash inflow to the exporter. But understand, this was payable to the exporter after 60 days only. And if the bank is paying you 60 days before, you will be charged for the interest. Okay, sir. 8% interest will be charged to you. But there is one more thing given in the question which will change the calculation of interest. See, the transit period is 20 days. And what do you mean by the transit period? Transit period, or you can say the usance period, or you can call this letter of credit as usance letter of credit. What happens under this type of letter of credit is, importer gets some extra days to make the payment. So that is 20 days. Now what will happen, because of this 20 days of the transit period or the usance period, importer can make the payment 20 days. Importer gets 20 days to make the payment even after the due date. So practically speaking, now the banks are not going to receive the 5 lakh euros on your behalf after 60 days. They are going to receive it after 80 days now. 60 plus 20, 80 days. So tell me, the cash flow that the bank would have given to you was after 80 days. But now you are asking it at 0 time. So the interest will be charged for 60 days or 80 days? It will be for 80 days, sir. 80 divided by 365. So what will be the amount of interest? That's 322,101. Remember this one as well. Got it? See, there are 3 things which the institute has asked, which the question has asked. Exchange rate quoted to the company. This was the exchange rate quoted to the company, 73.4793. Okay. You might say that the exchange rate should be also after 80 days. No, sir. It will be of 60 days only. Then, cash inflow to the company. 183,69,825. Let's cross check with the answers by the institute. See, 73.4793, this is the first answer, cash inflow to the company, and then 80 days interest rate, 8%, 80 days, 322,101. These are the 3 answers. With the ambiguity we are leaving this question, that the margin should have been deducted here, and this will change the exchange rate, this will change the cash inflow, this will change the interest as well. So all the answers will get changed if you adjust the margin here. I don't know why the institute is not doing it. Okay, sir, I'm just leaving this question here. Question number 57 onwards we are going to discuss after this break. So welcome back everyone. In this part we are going to start with question number 57. Question number 57 to I think 63 or something, we are going to discuss about, like, question from the question number 57 itself, we are going to start the discussion of risk management in Forex, and we are going to discuss the hedging part in that. The hedging part can be divided into two different areas, the internal hedging and the external hedging. Internal hedging is a point where a company, without taking the external help, can manage the exchange rate fluctuation. So what exactly we do in that internal hedging? The very first option we have is home currency invoicing. Instead of invoicing the bill in foreign currency or the customer's currency, if we invoice it in our home currency, then the risk is shifted to the other party. Now he has to arrange rupees, the other party has to arrange rupees for us if we are exporter. If we are importer, we can request the client to invoice the bill in rupees, so that the total outflow to us today or after 6 months remains same. So that is called as home currency invoicing. But most of the time home currency invoicing is not preferred by the customer. There are chances that you may lose the customer. The customer does not want to take any kind of a foreign exchange risk, and in that manner he may get shifted to the other vendors if you do not agree for the foreign currency invoicing. So home currency invoicing is a measure or is a tool to avoid the exchange rate risk, but it comes with a risk, another type of a risk, which is the loss of customer. The second is the leading and lagging. Leading means if you have receivable or if you have payables. Leading means settling the transaction before due date. Leading means settling the transaction before due date. Lagging means settling the transaction after due date. Why a person will do that? It's obvious that if the rates are not, if we expect as an importer or as an exporter, if we expect that the rates will not be in our favor, the exchange rate will not be in our favor on the due date, then we may take some action either to make the payment early or receive the payment early, or lag it. Or lag it means postpone the payment by a couple of months or a month. Whenever the rate seems fine to us, we are going to shift the cash flow, cash outflow and inflow on that date. It can be a leading, it can be lagging. Leading means settlement before due date. Lagging means settlement after due date. And this is done only to avoid the unfavorable exchange rate on the due date. We are not settling on the due date because we are expecting that on due date we will have unfavorable exchange rate. I will just give you an example of the same before starting the question. Let me just go through it. Now understand, let's say you are exporter. Okay, so you might have sold the goods on this date, and let's say you have an invoice of $1 lakh that you are about to receive after 6 months, or let's say after 3 months. So you will receive $1 lakh on this date. Now understand that if you are expecting the exchange rate to be rupees per dollar 55 on that date, and you expect that today the rate is 60, tomorrow it will be 62, and the day like after 2 months it will be around 60, and then after 3 months it will be 55. So it is better if the customer to whom we sold the goods agrees to make the payment after 2 months. Right? Because the rates are in our favor. Obviously, the customer who has purchased the goods from us with a 3 months credit will not be easily convinced to make the payment 1 month before the due date. Now, in that case, we will have to convince him by giving the discount on the invoice. Let's say we offer him a 2% discount if he makes the payment 1 month before the due date, and 2% seems good news for him, and he agrees to make a payment of $98,000 before like after 2 months itself. So that is 1 month before due date. Now if you get $98,000 after offering the discount to him, you will convert that at 60 rupees, and the total amount that you will receive in your bank is 58,80,000, right? Now you have one more benefit. Obviously you lost $2,000 in the invoice value, but you have a benefit that you can earn 1 month's interest rate here because you received the money 1 month before. So the benefit to you will be you can invest that amount for 1 month. Let's take an example that we want the funds only after 3 months. So even though we have received the funds after 2 months because of the favorable exchange rate and the discounts that we have offered to him, what we are going to do with this money is we will invest that for the next 1 month. Let's say the Indian currency interest rate is 12% per annum. That means it is going to be 1% for 1 month. So we are going to earn 1% on this. At the end of the 3 month, we will have around 59,38,800 in this option, where the receivables, we lead the receivable, like this is called as leading the receivables. Leading means settlement before due date. So due date was 3 months, settlement was done after 2 months itself. But obviously it was not easy for us to do the settlement. We offered him discount, he agreed to it, we received the money, we invested that for 1 month, and at the end of 3 months we had 59,38,800. Cool. But compare this option with the option with this option. Now if he was about to pay $1 lakh at the end of 3 months, we would have converted that at 55 rupees and we would have received only 55 lakh by selling those dollars. Now you choose which option is better. The option of giving 2% discount is still better, as it is giving you more in terms of rupees as compared to this. So even after not giving the discount and receiving $1 lakh entirely, we are not getting that much of the rupees which we are getting at $98,000 itself. This is called as leading the payable, and everyone would do that. Like this is the benefit for the exporter also, and this is in the benefit of the buyer also, as he is getting 2% discount in his own country. That's a big thing for him. So this is called as leading the receivables. In the same manner, we will lead the payables. You can just think from the importer point of view in this case. Let's say I will just take another example, not to confuse with the existing one. Let's say we are importer and we have $1 lakh payable, and we would pay $1 lakh at the end of 3 months. So we got the credit period of 3 months to make the payment to the supplier in other country. But we are of the view that after 3 months, sir, exchange rate will not be in our favor. So let's say, for example, the exchange rates are like this, 50. We are expecting it to increase over a period in this manner. And we are afraid that the exchange rate will not be in favor when we will have to make the payment. Now in this case, it is better if we make the payment at this rate 2 months before. So 1, 2, 3, 1 month before the due date. Now understand that if we offer the supplier in the other country that instead of making the payment at the end of 3 months, let me make the payment after 2 months itself, the supplier will not say no. It's in his benefit, because even if he is receiving at the end of 2 months or he is receiving the cash flow at the end of 3 months, he is getting $1 lakh. Receiving the amount 1 month before is in the favor of the supplier itself. He will never say no to it. So what we will do is, instead of making payment at the end of 3 months, we will do it at the end of 2 months itself, and this way our cash outflow will be 55 lakh rupees. Obviously, we will lose the interest on 1 month, interest on this amount for 1 month. Because we made early payment, we might borrow this amount for 1 month. So if you borrow this amount for 1 month at 12% per annum, you will have to pay interest rate. Making early payment will cost you a loss, cost you in terms of loss of interest opportunity. You might be losing an interest opportunity to earn 1% income on that, because the original due date was 3 months. And if you are making the payment 1 month before it, you are losing the interest. Okay, so 55 lakh plus 1%. That means the total cash outflow to you at the end of 3 months is 55, 55, 000. Right? But if you would have gone the original way, it would have cost you around 60 lakh rupees. So isn't it better to make the payment 1 month before? That is called as leading the payables. Leading the payables. This was leading the receivable. In the same manner, you can do the calculations for lagging the receivable, lagging the payables. In that case, what will happen? You will delay the receivables. When you will delay the receivable, the customer will not say no, because in any case he has to pay $1 lakh at the end of 3 months. He will also have to pay $1 lakh at the end of 4 months. But the good part will be, understand, in the same situation, let's say we expect that at the end of 4 months the rate will be 60. The rate will be 60. So it's better for us that we ask the customer not to pay at the end of 3 months, but to pay at the end of 4 months. It's in his favor only, as he will get $1 lakh. He will get to keep that $1 lakh for 1 month. He can earn interest on that. So he will never say no to it. But there is a loss to us of interest income. Interest income for 1 month, as we are delaying our receivable. So we are losing 1% on this 55 lakh rupees. We would have received 55 lakh rupees at the end of 3 months. So 1% on that we are losing. Actually, interest. If we would have received $1 lakh at the end of 3 months, we would have invested that for 1 more month, and we would have carried forward till the end of 4 months. So let's try doing it. 55 lakh plus 1%. That is what we would have earned for 1 month. We can easily say that it will be 55, 55, 000. So at the end of 4 months, we would have received 55,55,000 from the investment proceeds. But if we lag the receivable, understand, if the customer himself pays the amount of $1 lakh at the end of 4 months, we will directly convert it at the going exchange rate, which is 60, and we will receive 60 lakhs. Still, it is better than 55.55 lakhs. So it's better to take the decision of lagging the receivables. Simple, isn't it? Simple. In the same manner, we can lag the payment. But understand now, we are the importer. Exporter, the supplier will not agree to lag the payment. The amount that he was about to receive at the end of, just understand, the amount that he was about to receive at the end of 3 months, now we are requesting him that he will get the amount at the end of 4 months. So he will lose an interest for 1 month. He will not agree to it easily. What we can offer is, we can offer some extra amount to him. That instead of $1 lakh, sir, I will pay $1,02,000. You can charge me interest on that of 2%. I will pay after 1 month. 1 month of the due date, you can charge me interest on this dollar. So he said that I will charge you 2% for 1 month. So we agreed to make the payment of $1,02,000 at the end of 4 months. Why? Because we thought that the rates will be in our favor. Rates will be in our favor. Yeah. So try making the calculations here. If you make the payment of $1,02,000 at the end of 4 months, $1,02,000 at the end of 4 months, the total outflow to you will be 56 lakhs 10,000 rupees. But if you make the payment of $1 lakh on due date, you will have to bear the cost of 60 lakh rupees. So outflow of 60 lakhs at the end of 3 months, or outflow of 56 lakhs at the end of 4 months. Obviously, outflow of 56 lakhs at the end of 4 months will be chosen by the importer. Why he will pay more? and that too 1 month before it. So even after paying the interest of $2,000, we are still able to reduce the cash outflow in terms of rupees if we lag the payables. So there are four different things that is going to happen: leading the receivable, leading the payable, lagging the receivable, lagging the payable. All of these will be done by us only if the rates are in favor, if we lead or lag. So what are we going to do in all the questions? We are going to compare the original payment on the due date with the leading and lagging option. But please understand that all the comparisons should be done at the end of the 3 months or 4 months. So the timing of comparison should be same. You cannot compare 55 lakh with 60 lakhs. You have to bring that 55 lakhs to this point. So 55 lakh, 55,000 can be compared with the 60 lakhs. Now you cannot compare 60 lakhs with this 56 lakhs 10,000. You have to bring that 60 lakhs 1 month ahead. So the timing of all the options when you compare should be same. So interest will be the factor in that. Let's try solving the questions of leading and lagging. Let's come to the compiler. So we are done with question number 57, right? Acha, let me go back to the concept sheet first. So from question number 57 to 62, I think 1, 2, 3, 4, 5, 6. 6 questions are there on leading and lagging. Obviously, we are going to take 2 to 3 at least of these. Let's have a look. The repeated ones will be given as homework. This is the first question. Let's have a look on this. NP and company has imported goods for US $7 lakh. Now understand that you are an importer for $7 lakh. The amount is payable after 3 months. So let's try putting this on the timeline, because it will make our understanding, like it will be easier for us to understand. 1, 2 and 3. So at the end of 3 months we have to make the payment of $7 lakh, right? And the company has also exported goods for US $4,50,000, and this amount is receivable in 2 months. So in this question we are the importer and exporter both, and that this amount is receivable at the end of 2 months. So this is an outflow and this will be an inflow. $4,50,000. Okay. For receivable amount, a forward contract is already taken at 48.90. Sir, already taken at this place. 48.90 is the amount at which we will receive 4,50,000 rupees. So obviously, see, we made the transaction at 0th time. We sold the goods to someone and we are about to receive 4,50,000 at the end of 2 months. Right? We knew that we don't want to take the risk of fluctuating exchange rate or unfavorable spot rate on that date, and that's why we already entered into a contract with the bank. It is called as forward sell contract, because we want to sell dollars after 2 months. So forward sell contract, we will sell every dollar at 48.90 on this date. Now, for receivable amount, a forward contract is already taken. The market rates for rupee and dollar are as under. The market rates for rupee and dollar. Spot rate is 48.5070. 2 months forward rate can be calculated with these points and 3 months can also be calculated with this point. So let's have a look. These are in ascending order. You can clearly see the swap points are in ascending order. We will add these points. So it will get 48.75 and 49 and 48.90, 50 and 40 and 49.15. So these are the forward rates. Okay. The company wants to cover the risk and it has 2 options as under. Cover the risk for what? We have already covered the risk for the receivables. So all Everything which the only thing that is left is the payables. They are not yet covered. Cover the payables in the forward market. Now if we want to cover these payables also in the forward market, we will have to take a forward contract. Just like this, we were about to sell dollars. After receiving this to the bank, we sold forward. We need to make the payment of dollar now after 3 months. We will have to buy it. So buy forward. If we want to buy dollars after 3 months, bank will sell dollars. The rate applicable will be this. Bank will sell dollars after 3 months at a ask rate 49.15. So this is the applicable rate today. You sold the forward contract, you will buy the forward contract. Buying the forward contract means buying the currency at a future date. Selling the forward contract means selling the currency at a future date. Okay. The other option is to lag the receivables by 1 month. That means ask this party who is about to pay us $4,50,000. Ask him to make the payments after 1 month. So 4,50,000 will get shifted to this place. And what will happen? Now on the same date we will be receiving 4,50,000 and paying $7 lakh. What we will do is we will ask these two parties to settle with each other for $4,50,000 and the net amount will be paid by us because it's a payable. Net amount will be paid by us to the first party. The party who let's say this is party X, this is party Y. Okay, so at the end of 3 months, what will happen? I will ask Y, instead of making payment to me, you make the payment to X. So this story will be over and I will ask X that the balance will be given by me to you after 3 months. So what is the benefit to me on this? I will have to only buy $2,50,000 at the end of 3 months at this rate. The rate is fixed now. The timing is fixed. You have to buy dollar, you have to buy dollars. Doesn't matter whether it is $7 lakh or $2,50,000. The rate is fixed, which is 49.15. So I will buy $2,50,000 at this rate only. So this will help me in reducing the exchange rate risk. First, second, in reducing the transaction cost also. Instead of transferring $7 lakh from India to America, I will be transferring only $2,50,000. So this is a practical way. This is called as netting. This is basically, we are not netting, this is matching. This is another concept of internal hedging where we match the receivable with the payable on the same date. So instead of asking this guy Y to transfer the money to India and then we transferring the money to America to X, we will ask Y to make the payment to X. So we are matching the receivables with the payables. So this is a question of lagging the receivable and matching also. Now, to lag the receivable by 1 month and cover the risk only for the net amount, which is $2,50,000. No interest for delaying the receivable is earned. Understand that we are asking the customer to delay the receivable. He is not responsible for delaying, so he is not going to pay any kind of interest on $4,50,000. No interest. Okay. Evaluate both the options if cost of rupee fund is 12%. Which option is preferable? Let's come to the answer directly now. So if we go by covering the payable and receivable in the respective market, not lagging, just going normally, what will happen? At the end of 2 months, we will receive $4,50,000 at the agreed rate. This is the amount that we will receive at the end of 2 months. And what are we going to do with this amount? 2,20,05,000. We cannot compare 2,20,05,000 received and 3,39,15,000 paid at the end of 3 months. You can see this is the amount payable. This is paid to X, this is received from Y. But this is paid at the end of 3 months and this is received at the end of 2 months. Both cannot be compared. So what are we going to do? I told you that all the comparisons should be made only at a certain date. One date only. So at the end of 2 months, we are going to receive this much. We will invest that at 12% for 1 month and earn an interest of 1 month. At the end of 3 months, we will receive 2,20 lakhs. Sorry, this much. Total of this will be received at the end of 3 months. And the total of this 2,20 lakhs and 2 lakhs will be set off with 3 crore 39 lakhs, and the net amount payable at the end of 3 months comes to this 1 crore 16 lakhs. So practically what is happening? The amount that you are receiving at the end of 2 months, you are investing it for 1 month, and you will get it back along with the interest at the end of 3 months, which you are going to set off with the payables, and the net payables is this 1 crore 16 lakhs. So this is what will happen if you cover the receivable and payable in the respective market, right? But if you cancel the existing forward contract, understand, if you lag the receivables by 1 month, what will happen to the contract that you have already taken? You will have to cancel this contract. Now, in order to cancel this contract, remember that you had a forward sell position. You agreed to sell the dollars to the bank after 2 months. Cancellation is not an easy task. You will have to bear the cancellation charges, and cancellation can only happen by taking opposite position. So you had taken 2-month forward sell contract. Now you will have to take 2-month forward buy contract in order to cancel the original contract. So you have to create such a situation that whatever you were about to sell at the end of 2 months, you will be buying it first at the end of 2 months, because you are not going to sell 4,50,000 now. This party will not pay at the end of 2 months now. So what will you sell at the end of 2 months to the bank? Because to the bank you agreed to make the payment. So you will buy. Understand how to cancel it. We will learn about the cancellation of the forward contract later on, but this is the starting point. If you want to cancel the original contract, take the exactly opposite contract. That means if you have a sell position, take a buy position. If you have a buy position, take a sell position. And understand that both the contracts should have a maturity of the same date. On the same date, both should be expiring. So from today, it's 2 months for this contract, and from today it's 2 months also for this contract. So 2 months forward buy. If we want to now, what does that mean? We want to buy dollars after 2 months. So if we want to buy dollars after 2 months to cancel the contract, you can see after 2 months we will buy the dollars, bank will sell the dollars, the rate applicable will be 49. So we are practically cancelling the dollar. We would have received 48.90 by selling $1. Now we will have to pay 49 rupees for buying $1. So the dollar will get cancelled, but you can clearly see that the outflow is more to you. You are paying 49, receiving 48.90 just because of the cancellation on every dollar. You are losing 10 paisa. And so how much will you lose on $4,50,000? See. I think they have changed the rate. Let me just go through it. $48.90 and 48.30. Acha. So there is a mistake in the question, and for that they have given the note. So what they did is, they have changed the forward contract, since this question is little old. So what they did is 48.70 was the ask rate of spot, and instead of adding 30 points, they replaced these points. So they made it 48.30 instead of 49, and that's why the entire answer got changed. So instead of writing 49 at this place, they are writing 48.30, and instead of having a loss on it, we are calculating the profit. But let me tell you one thing, question is very clear about it. In the question, it has not been clearly mentioned that whether the quotes given for 2 and 3 months are premium points or a direct quote. Although above solution is based on the assumption that these are direct quotes. but students can also consider them as a premium points and solve the question accordingly. So now the answer will change for sure. What will happen? The loss will be 49. According to me, it should be a swap points or a premium points, and the answer should be according to that, because the rest of the questions are done like this. This was the only question where they got misplaced. Like a couple of questions are only there in the entire syllabus where they replaced the points instead of adding or deducting. Most of the time we will assume it as swap points. If I go with that, the rate will be 49 at which I will be buying, and the rate will be 48.90. This is the selling rate, this is the buying rate. I'm losing 10 paisa on 4,50,000, so the loss will be 45,000 rupees. Got it? Okay, so this is covered. This is going to be a loss to you for 45,000. Second thing, you cancel the contract now. What will happen? Now you can easily cover the payable, that to net payable. So $7 lakh is payable, 4,40,000 is receivable. Now this is at the end of 3 months. This is also at the end of 3 months because you have lagged it. So the net payable at the end of 3 months is 2,50,000, and the rate will be, just understand, the rate will also be little different. The rate will be 49.15. In this case also you will have to change this rate of to 49.15. So answer will change drastically if you consider them as the swap point. They have made this mistake. They should not have done it. 49.15 instead of this. So 2,50,000 into 49.15 will be the answer. That will be 122,87,500. So now you have to pay this much plus the loss. So the net outflow will be 123,32,500. This is the final answer of this option. Let me calculate the final answer of this option. 7 lakh into 48.45. Sorry, 7 lakh into 49.15. That's around 3 crore 44 lakh 05,000. Okay, this will remain same. The total of these two, 220,05,000 plus 220,050, that's 22,22,5050. So this is the received amount, this is the paid amount. Let's calculate the net amount. Do you understand this? If you take it as a swap points, this is going to be the rate and this is going to be the payable after 3 months, and this is the amount invested by you, the receivable of 4,50,000 converted at the agreed rate and invested back for 1 month. So this is the receipt, this is the payment at the end of 3 months. $1,217,9950. 1,217,9950. This is the outflow if you cover the payable also in the market. If you do not lag it, then if you do not lag the receivable, you receive the receivable at the rate and you make the payments at the agreed rate. 1 crore 21 lakh is the outflow here, 1 crore 23 lakhs is the outflow here. So what will be your decision? Your decision will be to have a minimum outflow. Minimum outflow means do not cover the payable, do not lag the payables. Sorry, do not lag the receivables, but instead cover the payable in the forward market so that the outflow is less. So what should be the solution? Since net payable amount is least in case of first option, hence company should cover the payable and receivable in the forward market for 2 and 3 months. Do not lag it because this is giving you more of the outflow. Okay, sir. Let's move on to the next question. We will have better clarity on that. Question number 58. An Indian importer has to settle an import bill. Now we are importer. We have to make the payment. That means we want to buy $1,30,000 at expiry. The exporter has given the Indian two options. Pay immediately without any interest charges. So if we make the payment of $1,30,000 today, we will not have to make any interest payment to the supplier. Pay after 3 months with interest at 5% per annum. So we can make this payment after 3 months also. But at that time we will have to pay a little higher Because we are delaying or we are lagging the payables, the supplier is charging us 5% directly on the invoice value, and that too per annum. 5% per annum, that means 1.25% for 3 months. Let's calculate. That's $1625. So in total we will have to pay $131625, $1,31,625 at the end of 3 months. So you choose if you want to make this payment or this payment. So what is the benefit, sir? If you will make this payment, you will have to arrange the rupees today itself, and you will have to bear the interest cost on rupees for 3 months. Right? That is what you need to make sure. The importer's bank charges 15% on per annum on overdraft. So if you borrow rupees to buy $1,30,000 and make the payment today, you will have to pay 15% interest per annum on that rupees. The exchange rates in the market for rupees per dollar are as follows. Now understand, in order to buy $1,30,000, you will have to buy dollars, bank will sell dollar, dollar is the base currency. Every time put the requirement to the bank in terms of base currency. We want to buy the dollars today, bank will sell it, ask rate of the bank will be applicable, that is 48.36. So what are you going to do? $1,30,000 into this. So that comes to 6286,800 rupees. Now you will have to arrange this much of the rupees in order to buy this dollar and make the payment to the supplier. But now you will be bearing an interest cost of 15% on this amount. For 3 months, it is going to be 15 divided by 4, that means 3.75%. This is the interest cost. So 6286,800 plus 3.75%. At the end of 3 months, it will be 6522,555. So this is the cash outflow at the end of 3 months in terms of rupees if you go for the first option. If you pay immediately to the supplier, you will have to arrange the rupees which you will borrow from overdraft, and at the end of 3 months it will be 6522,555. But if you ask the supplier itself that I will make the payment after 3 months, now the interest will be charged by the supplier. So 131625. This is the amount that you have to make, you have to pay after 3 months. You will simply enter into buy forward contract today to buy the foreign currency of 131,625 at the end of 3 months. You want to buy the dollars? Bank will sell the dollars at this rate. So 131,625. Just simply multiply. No interest on the in Indian rupees because you are not borrowing Indian rupees in this phase. That's 64,27,249. So I think the second option is preferable because it involves less outflow. 64,27,249. Let's have a look. 65,22,555 and 64,27,249. 64,27,249. See, clear? Now some students will get confused that this is the 3 month end. Sir, if we are making the payment to the supplier at the end of 3 month, we will need rupees. So are we going to borrow rupees on this date? And if we borrow rupees on this date, who is going to pay the interest? And why we are not considering the interest? Now this is the wrong approach of looking at the answer. Every time you need rupees and you will think of borrowing it, that's wrong. So we have to stop somewhere. We will assume that since 3 months is the last day, beyond that there is no question. So if this is the last day, we will use our funds. Before that, if we have to use any kind of a rupee, we will consider the opportunity cost of it, or we will consider that we are borrowing it. The only assumption will be that we will have our funds and we are not required to borrow at the end of 3 months or at the end of the maturity. So we are assuming that 64,27,249 will be paid from our pocket at the end of 3 months. Also, whatever we borrowed, 62, 86, 800 at time 0, right? At time 0 to make the payment of $1,30,000, that will be repaid after 3 months along with the interest from our pocket. So these outflows are at the end of 3 months and that is from our pocket. We are not going to consider that we are going to again borrow to make the repayment of previous borrowing. So how are you going to repay this borrowing? You will again borrow to make the repayment of the previous borrowing. This story will go on and on and on. You will keep on borrowing in this manner. You will have to stop somewhere to take the decision. So in this case, it's better to delay the payment. So this option is preferable. Pay after 3 months because of the less cash outflow. That's it. Move on to the next question, 58. See, question number 59 is your homework now. Why? Pay in 3 months time with an interest of 10% and cover the risk in forward market. This was the second option in the previous question. And settle now at a current spot rate and pay interest of the overdraft for 3 months. Yes, this was the first option in the previous question. So only difference is they have just replaced the question. The second part was asked in the first part in the previous question. First part in this case was asked in the second part in the previous question. So take this as an homework. Let's take question number 60. Z Limited importing goods worth USD 2 million. Z Limited is importing goods worth USD 2 million. So he is an importer. Requires 90 days to make the payment. Now the supplier who has supplied the goods to us has offered a 60 days interest free credit. So he's not asking the payment today. He's saying that you can make the payment after 60 days. I will just draw it here. 30 days, 60 days, 90 days. 30, 60, 90. Okay. So he's saying that till 60 days, you can make the payment without any interest. How much? $2 million. So that's around 20 lakh dollars. Okay. So if we make the payment after 60 days and that to this much amount, it's very simple that we will buy the dollars. Since we are importer, we want to buy the dollars, bank will sell the dollars. And if the dollar is the base currency, ask rate of the bank will be applicable. You can clearly see 60 days forward rate is, there is a one-way quote. So no ask rate, no bid rate. Just pick 57.10. 57.10. So the total outflow to you is 57.10. That's 11 crore 42 lakhs. Sorry, I think 114 crore 20 lakh. 114 crore 20 lakhs. Right? On this date. Obviously, we will compare both the options at the end of 90 days. So we will consider that either of the two. Either we are going to borrow this for 1 month and take it to the end of the 90 days, or we are losing an opportunity cost for 1 month. In both the cases, 1 month interest has to be added in this before calculating the cash outflow. This is outflow. So what is the rupee interest rate? And for additional credit of 30 days, an interest of 8% per annum. So Z Limited is saying that if you pay at the end of 60 days, this is what you have to pay. But if you choose to get an additional credit of 30 days, you can make the payment of $20 million here. But you will have to pay interest of 8% per annum. So understand that the interest of 8% per annum into 1 by if the question, let me see if the question is asking for 365 days or 360 days. Nothing is like that. I will take the 360 days. 365 days can also be taken. (1/12) for 1 month. So I will take 360 days itself, 8% divided by 12. So that comes to 1,33,333. So now if I make the payment at the end of 90 days, the total payment will be 20133,333, this much. Instead of 20 million, we have to make 20.13 million. Okay, not an issue. And what will happen? In order to make this payment, we will take a forward contract. We want to buy the dollars, bank will sell the dollars. Okay, the 90 days forward rate is also given to us, which is 57.50. 57.50. The total outflow will be 1157666648. Okay, this is the outflow in the second case. But what will happen to this? You will borrow this amount, 114 crore, for 1 month, and the interest on that has to be paid. Bankers are offering the loan at 10% per annum, and their quote is as follows. So 10% for 1 month. Let's calculate. 10% into 1 by 12. The interest cost will be 114 crore, 20 lakhs into 10% divided by 12 goes to 95,1666. 4 sixes are there, or 7, and the total will be this much principal and this much interest. That's 115,151,6667. So you can see this is 115 crore 76 lakh 66,000. This is 115 crore 15 lakh 16,000. Which option will you choose? If you make the payment at the end of 60 days, this is the only amount that you have to pay to the supplier at this forward rate, but you will have to borrow rupees for that for 1 month, on which you will be paying 95 lakh 16,000 rupees of the interest. The total outflow will be 115 crore 15 lakh, and in this case it is 115 crore 76 lakhs. So like, it's very easy to come to the conclusion that it's better to make the payment at the end of 60 days because of the less outflow in that case. See, if you pay at the end of 60 days, 115 crore 15 lakh, it is 20 million or 2 million. Okay, that's my mistake in the entire question. Please forget me. I took 20 million instead of 2 million. So all you can see that I have added one extra zeros in the entire answer, but it was 2 million itself. That means 20 lakh dollars. And if I go to 20 lakh dollar, 1 zero can be eliminated. So the answer is almost same, but without 1 zero. So this is 11 crore, not 115 crore. It's 11 crore 51 lakh, and this is 11 crore 57 lakh. Which option will you choose? 11 crore 51 lakh. That's it. Pay the supplier in 60 days because of the lesser outflow. These type of questions are easier to solve. Now the next question. Again the same, you are going to take it as homework. See, interest free credit for additional interest free credit for 60 days, and for additional 30 days this much of the interest. This is US 1 crore dollar, and you are importer. That means you will buy the dollars at the end of 60 days. Okay, so if you buy the dollars at the end of 60 days, how much you have to buy? 1 crore dollar, and you will be paying taking the forward contract of 60 days. So 63.15 into 1 crore, that will be 63.15 crore rupees, and that rupees you are going to borrow for 1 month because you are getting an additional credit of 30 days. See, it is very easy. 1 crore into 63.15 will give you 63.15, and you will pay additional interest on this amount for 1 month, at the banker 9.5% per annum. 9.5 divided by 12, that comes to 0.7917% for 1 month. You add that amount to 63.15. The second option is to get the credit itself for 30 days from the supplier, but he will charge 7.75% on this amount. So 1 into 7.75% divided by 12, that comes to 0.006458. 0.006458 crore in terms of dollar. So 1.006458 crore is what you are going to pay at this rate. 90 days rate. Same question. See, 1.00646 at the 90 days. Alternative 1 is still better in this question to make the payment at the end of 60 days because of the less outflow. 63.65 crore, 63.86 crore. Outflow is less in this case. Follow that. Pretty easy one. Now this is something which I think we should take because it has 3 different timing: immediately, 60 days and 90 days. Let's read the question. Okay, let's have a look. XYZ Limited has imported goods. In this question also you are an importer. That means you are going to buy the foreign currency in order to make the payment to the supplier. If you will buy, bank will sell. But in this question it's very easy because the bid and ask quotes are not given. So it's very easy to pick the rates. To the extent of USD $8 million. The payment terms are as under: 1% discount if full amount is paid immediately. I think I will love this question and I will try not to make the mistake of millions. Question number 62. Immediately, 30 days and 90 days. 60 days and 90 days. So 0, 30, 60, 90. I can make the payment immediately. How much is the amount? $8 million. And I will get 1% discount if I make the payment immediately. That's how much I have to pay today. 792,00,00. Sorry, 792,00,00. Okay. All the options will be compared at the end of 90 days. You can bring all the option at 0 point or take all the option at 90 days, but the timing has to be same. So if you have to make the payment of this much amount today, what are you going to do? You are going to buy the dollars at spot rate, which is 66.98. Okay, let's do that. That means you need this much of the rupees, 53 crore 4 lakh, sorry, 81,000. 53 crore 4 lakh 81,600. This is what is required. How are you going to manage this much of the funds to make this much of the payment to the supplier? Obviously, we will borrow it for the next 90 days in India. And Indian borrowing rate will also be available in this question. Let me just take it. Offer from bank for a loan up to 90 days, 9% per annum. And see, there are few things you need to notice. Further, presume that the cash available with XYZ Limited will fetch a return of 4% per annum in India till it is utilized. Assume year has 360 days. Ignore taxation. Compute your working up to 4 decimals and cash flows rupees in crore. So instead of writing the entire figure, it should be rupees in crore. 53.0104. Okay. There are few things that we need to understand. Let's read the question first before making any mistake. So 1% discount if full amount is paid immediately. 60 days interest free credit. However, in case of a further delay up to 30 days, interest at the rate of 8% per annum will be charged for the additional days after 60. So what he is offering to make the payment immediately, and that will be 79,20,000. But if we choose to make the payment at the end of 60 days, then 100% has to be made. That is $8 million, $80 lakh. Okay. And if you choose to make the payment further after 30 days, we will have to pay the interest on that to the supplier. How much interest? We will pay around 8% per annum. So into 8% into 30 by 360. So the interest amount will be, we will be asked to pay this much of the interest, 53,333, and the total amount will be 80,53,033. So these are the three amounts that we are required to pay on various dates to the supplier. Okay, cool. Let's read the question now. Now, this is where we are going to, this question becomes interesting. Will be charged for additional dates. Messrs XYZ Limited has 25 lakh rupees available, and for remaining it has an offer from bank for a loan up to 90 days. See, we are not required to take the loan for the entire amount. We can use the 25 lakhs that is available with us. But what will happen if we use that 25 lakh rupees in this transaction? We will lose the interest of 4% per annum on that. So practically speaking, this is a question where you have to take 4% interest on the first 25 lakhs, and on the balance amount of loan, you will take 9% per annum. If you use the 25 lakh rupees that is lying with you in this transaction, you will lose the opportunity to earn 4% per annum on that. So it is, in another sense, it is a kind of a loan available at 4%. And beyond that, it is 9%. So you can clearly understand that 0 to 25 lakh rupees of the loan is available to you at 4%, and 25 plus loan is available to you at 9% per annum. This is how you have to consider, because the first 4% will be lost. Like, this will be an opportunity lost to you. So I am not going to borrow entirely 53 crore rupees. The 25 lakh rupees will be, I can say 25 lakh rupees will be used by me first and then the balance will be borrowed. So that's it. Further, presume that the cash available with XYZ till it is utilized. Assume year has 360 days. Ignore taxation. Computer working on up to 4 decimals. And cash flows in rupees. So 53 crore 0482. 4 decimals and in crores. This much we have to pay today. Okay. So this 25 lakhs can be considered in two different ways. Either we can take the opportunity cost, or we can take the income earned from that 25 lakh rupees. If we use the 25 lakh rupees today itself, straight away, for the next 90 days, we are not going to earn anything on that, because we used this 25 lakh rupees in this first option of $7.92 million. We will require 0.2500 crores. How will you write 25 lakh rupees? This is crore and this is the lakhs that are starting. 53 crore 4 lakh and this is 25 lakh. This is the amount already available with you. So the only amount of loan which is required is minus 0.25. 52 crore 79 lakh 82,000. Right? And this you will borrow for 90 days. So 52.7982 in bracket 1 plus 0.09 is the rate for 90 days, right? So 0.09 into 90 by 360 plus 1 into 52.7982. So that's 53 crore 98 lakh 62,000 rupees of the outflow in the first option. Do you understand that? This is the first option. So $8 million minus 1%. This is how much you have to pay at the spot rate. Comes in the crore is this much. We already have 25 lakhs with us out of the required amount. So the loan required is this much. So the net outflow will be this much only. 53 crore 98 lakhs. The rest amount was used by us. 53 crore 98 lakh 62,000. Now, suppose if we make the payment at the end of 60 days, what will happen? There will be two different things. From 0 to 60 days, we are going to earn an interest on 25 lakh rupees. That's what the question is saying, that for the unutilized period, we are going to earn 4% interest on that. So first, let's take 25 lakh rupees. Let's invest 25 lakh rupees today and calculate the interest for 60 days on that. So you can easily do that calculation here. 25 lakhs into 4% into, I can do the calculation like this. 1 plus 0.04 into 60 by 360. This is how much I am going to get on this 25 lakhs. So 0.04 into 60 by 360, 0.04 into 60 by 360 plus 1 into 0.25. So the amount that I will have on this date is 0.2517 crore. I have a little higher amount to adjust with the required amount. Now, if I want to make a payment of $8 million after 60 days, I will take the forward contract, first of all, of 60 days. That's, I think, 67.16. Have a look. Multiplied by 67.16. So the amount in crore which is required is 53 crore 72 lakhs 80,000 rupees. So this much of the funds in terms of rupees is required, and you already have this much out of that. So the only amount of loan required is minus 0.2517. 53.7280 minus 0.2517. So the loan amount required is 53.4763. Now you are going to borrow this amount for a period of 1 month only, because we have to take the cash outflow at the end of 90 days. So there is only 1 month. 1 month means 1 plus 0.09 into 30 by 360. You are going to multiply this amount because you are borrowing this, and the interest will be calculated like this. At the end of the 90 days, you will be paying 0.09 into 30 by 360 plus 1 into the amount of borrowing. That comes to 53 crore 87 lakh 74,000. So I think second option is still preferable because it involves lesser cash outflow as compared to the first option. Do you get that? This 25 lakh rupees was invested for the 2 months because it was not required, and we received 25 lakh 17,000 at the end of 60 days, which was adjusted in the required rupees in order to make this payment. Now let's come to the end of 90 days. We need to make this much of the payment, and understand the forward rate at the end of 3 months will be applicable, which comes to 68.03. $68.03. So the required amount will be in terms of crores 54.7868. Okay, but for the entire 90 days, we didn't need this 25 lakh, and we would have invested this amount for the 90 days. So what is the amount available with us? This 25 lakh rupees and the interest of 3 months. $25 lakh 1 plus 0.04 is the interest on this for 90 days. So we will have 0.2525 on that date. So at the end of 90 days, we needed this much amount in order to buy the dollars, and we already had this much amount of our investment. So the net amount is 54.7868 minus 0.2525. So that's 54.5343. Now you choose which option is better. Let me first check the answers, all the three answers. 53.9862. It's better to take it this way. 53.9862, the last one. This is the first answer. Then 53.8774, this is matching with this answer. And 54.5341, and it is 54.5343. This is third. Why there is a variation? Let me 54.7866, 8.0805333, 053333, 68.03, 34. 547868. Yeah, it's 547868. So that's just the rounding of difference. They have so all the three, these are the three answers matching with the institute's answer. You can see clearly the transactions. Now let's come to the institute's part. So this is the spot rate applicable. This is the amount payable after discount comes to this much of the amount required. We already have 25 lakh which we have used. So this, we will take the loan for 90 days of this much amount. The interest comes to this at 9% and the total outflow. This is again the same thing. So which option will be preferred? I think the second option is preferred by us to make the payment after 60 days, because the first option is giving us higher payment, 53.98, and this is 53.87 only. And this is 54.53. Cash outflow is least in case of option 2, same should be opted. So do you understand this with the help of the timeline? It's very easy to understand the cash flows, like exactly what is happening at which point. 25 lakh rupees was not available at all for the 90 days in the first option, but it was available for investment for 60 days in the second option and for 90 days in the third option. So at all point, the use of that changed. It was 25 lakh in the beginning, it was 25 lakh 17,000 at the end of 60 days and 25 lakh 25,000 at the end of 90 days. Okay, sir. With this, I think we end our discussion on leading and lagging. Yes. Those were the easiest question. So all the questions of 57 to 62 leading and lagging has been over. The only one question which you are required to do before exam is this question 16.2 that we have just seen. This is the difficult one and this covers everything. So you can take 62 and 61 also. For one question will be easier and the other one will be difficult. After the break, we are going to start with hedging of the forward contract, and these are going to be again amazing questions. Lots of questions are there on the forward contracts in the coming time. See you.